The market feels good right now, too good. You open your phone, you see the S&P 500 flirting with all-time highs, you hear the talking heads on television celebrating the soft landing, and you feel that familiar tug, the fear of missing out. Everyone around you seems to be getting rich, and if you're not in the game, you're falling behind. I understand that feeling. I felt it myself. But I'm looking at something different from my office. I'm looking at the foundation beneath the party, and I'm seeing cracks, not small ones, the kind that don't show up until the weight comes down hard. We are obsessing over Jerome Powell. We are obsessing over whether the next rate cut comes in June or September, and we are completely ignoring the one thing that actually powers every single company on that stock market, oil. Not just gasoline for your car, the diesel that moves every product you buy from the ship to the warehouse to your door, the energy that runs the factories, the feedstock for the plastics, the fertilizers, the chemicals. When oil moves, everything moves with it. And oil is getting ready to move in a way that the complacent market is not pricing in. The supply crunch is real. Global production capacity is stretched thinner than it has been in a generation. The spare capacity that used to act as a shock absorber for the system is gone. And here's what the average trader misses. Demand doesn't have to spike to cause a crisis. All it takes is one supply disruption, one geopolitical event in the Strait of Hormuz, one escalation nobody saw coming. And suddenly the price of oil doesn't go up 10%, it goes up 30%. And the market, sitting comfortably at all-time highs, realizes it built its entire valuation on an energy assumption that just collapsed. If you want to understand where your portfolio is going, you need to stop watching the Fed and start watching the barrel. Because the Fed can cut rates all they want, but if the cost of doing business doubles, those cuts mean nothing. This is not complicated. This is physics. And right now, the market is acting like physics is optional. Before we go deeper into exactly how this plays out and what it means for your money, hit that subscribe button. Not for me, for the person you will be 6 months from now. Because 6 months from now, when everyone else is confused, when they are panic selling and asking what happened, you will already know. You will already have the framework, and that one click today is what separates the person who reacts from the person who prepares. Your future self is watching. Make that person proud. I have sat in rooms where the biggest banks in the world stress test scenarios that sound like fiction. And I can tell you, the scenario where oil supply tightens to the point of breaking something in the financial system is not fiction. It is not a black swan. It is a gray rhino charging straight at us, and everyone is looking the other way. Back in 2016, I watched the energy sector buckle under similar dynamics. The market thought prices would snap back. They didn't. And banks that were overexposed learned a very expensive lesson. That lesson was about leverage, yes. But more importantly, it was about the danger of ignoring the physical reality of supply. Here's the truth. We spent the last 5 years underinvesting in new production. Not because the oil disappeared, but because the narrative shifted. Capital fled the sector. And now, when the world needs that cushion, it's not there. The strategic reserves that governments built to protect against moments like this, lower than they have been in decades, the safety net is gone. So when a disruption happens, and it will happen, because it always does, there is nothing to catch us. The average person looks at oil and sees a commodity. The professional looks at oil and sees the cost of everything. And right now, the disconnect between the stock market's optimism and the energy market's reality is wider than I have seen in years. That gap does not close gently. It closes with a jolt. And when that jolt comes, it will not matter whether you were trading options or holding blue chips. It will only matter whether you saw it coming. The party is still playing. The music is loud, but I'm watching the exits and I'm watching the fuel gauge. Because when the music stops, and it always does, the people who survive are not the ones who danced the hardest. They are the ones who saw the supply chain tightening before the lights went out. That is where we are headed. And in just a moment, I'm going to show you exactly how this oil crunch travels through the economy, which dominoes fall first, and why the second order effects are going to catch the professionals just as off guard as the beginners. Let's walk through exactly how this happens, because most people think a stock market crash is a single event, a news flash, a red number, a sudden panic. That is almost never the case. What we are looking at here is a sequence, a cascade. And understanding the sequence is the only way to keep your footing when the ground starts to move. The first domino is corporate margins. Right now, companies are surviving on thin air. They have raised prices, they have squeezed suppliers, they have done everything they can to protect profitability in a high inflation world. But oil is the one cost you cannot negotiate. You cannot hedge it forever. When a logistics company fills its trucks, the price at the pump is the price. When a manufacturer runs its furnaces, the energy cost is the energy cost. If oil spikes 30%, that cost does not get absorbed. It gets passed on or it gets subtracted from earnings. And in this environment, earnings are already stretched. The moment we see a sustained move in oil, we will see earnings revisions across every sector that touches the physical economy. That is most of them. The second domino is the consumer. And this is where the psychology gets interesting. The American consumer has been incredibly resilient. You know this, I know this. But that resilience is built on savings that are depleting and wages that are barely keeping pace. When gasoline hits $4 a gallon, people grumble, but they adjust. When it hits $5, they cancel the streaming subscriptions. When it hits $6, they stop eating out. They delay the new car purchase. They pull back on everything that is not essential. And that pullback hits the revenue of every company that sells discretionary goods. Those companies then miss earnings, which hits their stock price, which hits the confidence of the consumer who owns those stocks in their 401k, and the spiral feeds itself. Back in my early days on Wall Street, I made the mistake of thinking the consumer was a monolith. I thought if the economy was growing, everyone was growing with it. That cost me. I learned that the consumer is a lagging indicator of stress. They look fine until the moment they are not. And the trigger is almost always a necessity that becomes unaffordable. Food, housing, energy. When energy spikes, it is a tax on everyone. A tax that does not show up on any ballot but hits every wallet. And the person making $50,000 a year feels it just as much as the person making $5 million. The difference is the person making $5 million does not change their spending. The person making $50,000 stops spending entirely. That is where the recession starts. The third domino is the bond market. And this is where even the professionals get confused, because the conventional wisdom says higher oil means higher inflation, and higher inflation means the Fed keeps rates high. That part is true, but the part they miss is the debt. Corporate America loaded up on debt when rates were zero. They refinanced, they expanded, they bought back stock. Now the debt is rolling over at higher rates. If oil spikes and slows the economy, those companies have two problems. Their revenue drops and their interest payments stay high. That is the definition of a squeeze. And when enough companies get squeezed, they start missing bond payments. Those bonds are held by pension funds, by insurance companies, by banks. Suddenly the problem is not just the stock market, it is the entire financial system. I sit in rooms where we run these scenarios. As CEO of JP Morgan Chase, I have to ask the hard questions. What happens if a major European economy, already struggling with energy dependence, sees its industrial base shut down because it cannot afford the gas? What happens to the banks that lent to those industries? What happens to the American money market funds that bought the commercial paper of those banks? This is not a theory. This is how 2008 started. A small crack in one part of the system that everyone assumed was isolated until it wasn't. Here is what I would do if I were sitting where you are. I would stop assuming that the market of last year looks like the market of next year. I would look at my holdings and ask a simple question. If oil goes to $120 and stays there for 6 months, which of these companies still makes money? Which ones have pricing power? Which ones have balance sheets strong enough to survive a margin squeeze? The companies that answer yes to those questions are your core. The ones that answer no are speculation. And there is nothing wrong with speculation as long as you know you are doing it. But most people do not know. They think they are investing when they are actually gambling on a continuation of conditions that are about to change. The psychological trap here is anchoring. We anchor to the prices we are used to. We think $80 oil is normal because that is what we have seen. But normal is a moving target. The energy regime of the last decade was defined by oversupply. The next decade may be defined by scarcity. If that shift happens, the entire valuation matrix of the stock market has to reprice. Not correct, reprice. That is a different word with different consequences. So now we have the dominoes lined up. Margins compress, consumers pull back, bonds wobble, earnings fall, the market drops. That is the sequence. But the question you're asking right now is the only one that matters. How bad does it get? And more importantly, what do I do about it? That is where we are headed next, because understanding the crash is useful. Knowing how to position yourself before it happens is everything. The question you are asking yourself right now is the one everyone asks when the fog starts to roll in. How bad will it be? And the honest answer is that nobody knows the exact depth, but we can know the shape, we can know the mechanics, And that knowledge is what separates the people who freeze from the people who move. Let me paint the picture honestly. If the oil supply crunch hits hard enough to trigger the dominoes we just walked through, we are not looking at a 10% correction. We are looking at something deeper because the market today is priced for perfection. It is priced for falling rates, steady growth, and contained inflation. Oil at $120 breaks all three of those assumptions simultaneously. That is the kind of shock that forces institutional investors to reevaluate entire asset classes. And when they reevaluate, they do not trickle out. They move in waves. The selling begets more selling. The margin calls go out. The leverage positions get closed. The algorithms that are programmed to buy the dip get overwhelmed and flip to selling. It becomes a machine. But here is what I want you to understand. A crash is not the end. It is a transition. It is the market moving from one set of assumptions to another. The people who get destroyed are the ones who are leveraged, the ones who are emotional, the ones who confuse the price tag on their screen with the actual value of the businesses underneath. The people who survive and eventually thrive are the ones who keep their heads while everyone else loses theirs. When I was young in this business, I made the mistake of thinking I had to be in the market all the time. I thought cash was dead money. I thought if I wasn't fully invested, I was missing something. That thinking cost me. It cost me sleep. It cost me flexibility. And it cost me opportunities that I could have taken if I had just waited. I learned that cash is not a position you settle for. Cash is a position you choose. It is the ultimate hedge. It is the ability to look at a falling market and feel calm instead of terror. Because when you have cash, you are not forced to sell anything. And when the panic is over, you are the one with the power to buy. If I were sitting where you are, looking at this setup, here's what I would do. I would look at my portfolio and I would stress test it against the oil scenario we just discussed. I would look at every company and ask myself, what happens to their earnings if energy doubles? The ones that survive that test are keepers. The ones that don't, I would think very hard about why I own them. I would also look at my debt. If you are trading on margin, if you have borrowed money to invest, this is the moment to reconsider that leverage. Because leverage works until it doesn't. And when it stops working fast. I would also think about duration, not just in bonds, but in my entire approach. If this supply crunch plays out, volatility is not a temporary condition. It becomes the new environment. That means the strategies that worked in a calm market, buy and hold, set it, and forget it, need to be adjusted, not abandoned, adjusted. You need to be closer to your positions. You need to understand what you own at a level deeper than the ticker symbol. You need to ask yourself whether you are investing or whether you are just hoping. The other thing I would do is watch the signals, not the headlines, the signals. Watch the oil inventory numbers. Watch what the shipping companies are saying. Watch the credit default swap spreads on European energy companies. Those are the canaries. When they start to move, the news is still weeks away. The market rewards people who see the canary. It punishes people who wait for the confirmation. And let me speak directly to the person watching this who is thinking about starting to trade. The person who sees the market as a way out, a way up, a way to finally get ahead. I understand that feeling. I understand wanting more. But please hear me when I say that the worst time to learn how to swim is when the ship is already tilting. The next 6 months are going to require a level of discipline that most beginners do not have yet. That is not an insult. That is just experience talking. If you are new, do not try to catch the falling knife. Do not try to short the crash. Do not try to get rich overnight. Use this time to learn. Use this time to watch. Use this time to build the habits that will serve you for the rest of your life. The market will still be here next year. Make sure you are too. As CEO of JP Morgan Chase, I have a responsibility to think about the system as a whole. And what I see is a system that is more fragile than the prices suggest. Not because the companies are bad, not because the economy is broken, but because the energy assumption underneath everything is shifting, and the market has not adjusted to that shift yet. When it does adjust, it will adjust violently. That is not a prediction of doom. That is just a statement of physics. Markets hate uncertainty. And right now, the certainty we thought we had about energy is the most uncertain it has been in decades. So here is where we land. You now understand the mechanism. You see how oil flows through margins, through consumers, through bonds, through stocks. You see why the complacency today is dangerous, and you have a framework for what to look at and what to ask. The rest is up to you. The market will do what the market does. It will crash or it won't. It will recover or it won't. But you get to choose how you respond. You get to choose whether you are prepared. You get to choose whether you are the person who panics or the person who acts. Share this with someone you care about, not because I said so, because they are probably making the same assumptions you were making 30 minutes ago. They think this is just another cycle. They think the Fed will save them. They think the dip will always be bought. They need to see the other side. They need to understand that the rules change when the fuel runs low. Send them this video, talk about it, argue about it. That conversation might be the one that saves them from a mistake they didn't even know they were making. The market is a story we tell ourselves. And for the last few years, we have been telling a story of abundance, cheap energy, easy money, perpetual growth. That story may be ending. A new story is beginning. Make sure you know which one you are living in. Make sure you are ready for the turn, because the turn always comes. And the people who see it coming are the ones who write the next chapter, not the ones who get left behind in the last one.